Hello dear students, welcome to another video lecture. In this lecture we are going to talk about and discuss adjusting entries and how we get prepared to prepare the financial statements like income statement, owner's equity statement and balance sheet. Let's revise and remember the accounting cycle. We said before that the accounting cycle starts by identifying the financial transactions, then recording these financial transactions within the journal and posting to ledger. After posting to ledger, we prepare a trial balance. This trial balance is called unadjusted trial balance. So the trial balance that you use to prepare after posting to ledger and preparing the account, now we know that its name as unadjusted trial balance. Why? Because we still need another step, which is preparing the adjusting entries. Then after preparing the adjusting entries, we move to make another trial balance, which is the adjusted trial balance. From this adjusted trial balance, we prepare the financial statements. So why do we need adjusting entries? We need adjusting entries after preparing the unadjusted trial balance to make sure that all revenues and all expenses belongs to this financial year, to the current financial year, and we make sure that the revenue recognized matches the expense paid. In other words, we need to know or to make sure that all revenues and all expenses are revenues and expenses that belongs to the current financial year. We also need adjusting entries because one single transaction may affect the revenues or expenses in more than one accounting period. For example, you may pay rent expense in advance covering 3 years. This affects the expenses for 3 years. So we need to make an adjusting entry to know how much rent belongs to the current year and how much rent will remain to the coming years. We also need adjusting entries because some transactions might not be documented or recorded. In short, adjusting entries are needed to ensure that revenue recognition and matching principles are followed. So, what types of adjusting entries do we have? We have number one, the prepaid items. Prepaid items like prepaid expenses, for example, like prepaid rent, prepaid insurance, prepaid advertising. We also have unearned revenues. These are revenues received in advance before you deliver your service. Number two, we have the accrued items like accrued expenses or liability like unpaid salaries, accrued revenues or assets like interest earned but not yet collected, and finally we have the estimated items such as depreciation. Let's start to discuss each type separately. First, the prepaid expense case. What do we mean by prepaid expense? These are expenses paid in advance that covers more than one accounting period or more than one financial year. Here we have an example. On January 1, 2019, so this is the beginning of a financial year, the company paid $1,200 for a 2 years fire insurance policy. So this means that this amount covers 2 years, 2019 and 2020. So by the end of December 31, 2019, we need an adjusting entry to tell us that only half of this amount belongs to 2019 as insurance expense, and the other half is kept for or transferred to 2020. So to record the previous transaction, we are going to make this journal entry. At January 1, prepaid insurance in the debit as it is an asset, and cash in the credit because it decreased. This is the journal entry to record the previous transaction. So how about at the end of the year, when we are in need to prepare the financial statements? We need an adjusting entry. At December 31, 2019, after we have done the journal like this, and we post it to Ledger, and we prepared already the unadjusted trial balance. We need an adjusting entry to say, or to determine how much expense from this amount belongs to 2019 and how much will be transferred to 2020, like this. So this is the adjusting entry for the prepaid expense for the previous example. Here is the adjusting entry. Insurance expense in the debit for 600. Why 600? Half the 1200. 1200 divided by 2. Because the insurance expense that belongs to 2019 is only half the amount paid. And prepaid insurance, which is an asset, will be placed in the credit side because it will decrease by the amount consumed in 2019. So insurance expense for 600 will appear in the income statement for 2019, and prepaid insurance will appear in the balance sheet for 600. The second case is office supplies case. On Jan 1, 2019, the company purchased supplies costing 4,500, and an inventory count at the close of business on December 31 reveals that only 2,500 is left. This means that we consumed how much supplies during 2019? We consumed 2,000 supplies. This is the expense. So first we purchased an amount that cost 4,500. We consumed 2,000 during the year, and still we have on hand in the inventory 2,500. So we need an adjusting entry to determine that we already consumed 2,000 from the supplies, which is the expense, and we have 2,500 on hand remaining and will be transferred to 2020 as an asset. So the journal entries will be as follows. So first we're gonna prepare the journal entry on January 1. What happened on January 1? We purchased supplies for 4,500 and we paid cash. So supplies will be placed in the debit, cash will be placed in the credit. So what will be the adjusting entry on December 31? The adjusting entry will be like this. Supplies expense in the debit for how much? For 2,000. What is these 2,000? It is the difference between the amount purchased at the beginning of the year and the amount remained in the inventory. The difference is how much you used or you consumed. You consumed 2,000 from the supplies. This will be the expense. So supplies expense in the debit for 2,000, and supplies, which an asset, will decrease in the credit. Then the supplies expense will be placed in the income statement, and the difference, which is, and the amount left, which is 2,500, will be placed in the balance sheet. The third case is the depreciation expense case. What do you mean by depreciation? Depreciation is a certain value that is deducted from the value of the fixed assets each year from its useful life. For example, if the company bought an equipment for 6,000 cash, the equipment has an estimated useful life of 5 years. It means that each year from these 5 years, this equipment will be deducted by a certain amount and its value will decrease. How do we calculate the depreciation? We divide 6,000 by 5. So the journal entry for recording purchasing an equipment will be equipment in the debit for 6,000 and cash in the credit for 6,000. But this is made or recorded on January 1. What about on December 31, 2019? On December 31, 2019, we will need an adjusting entry to tell us that there is an amount called depreciation expense equipment, which is the value that will be deducted from the amount or the value of the equipment. So an adjusting entry will tell us that we have a depreciation expense for equipments, and the value of the fixed asset will also decrease by the same amount. Here is the adjusting entry for depreciation. We are going to divide 6,000 by 5 and the result will be 1,200. 1,200 is the amount of depreciation that will be deducted each year for 5 years, which is the useful life of the equipment, until all these 6,000 is consumed. So each year from those 5 years we are going to make this same adjusting entry to determine the amount of depreciation, which is depreciation expense, which is equal to 1,200, and accumulated depreciation equipment for 1,200 will be placed in the credit. This will be deducted from the fixed asset called equipment in the balance sheet, and this will be transferred to or appear at the income statement as an expense. Another case is the case of unearned revenues. Unearned revenues are revenues received in advance. In advance here means before you deliver the complete service to the customer. As an example, the company received 1,200 on December 1, 2019 for services expected to be completed by February 28, 2020. So you received all your money in advance before you finish or you deliver the service to the customer. So at December 31, we need an adjusting entry to determine how much revenues belongs to year 2019 and what is left to 2020. So this is the journal entry previously made on December 1 to record receiving the cash amount in the debit and unearned revenue was recognized for 1,200 in the credit. Why in the credit? Because it's a liability. Why is it a liability? Because we received this amount and we didn't deliver the service yet. On December 31, an adjusting entry is made. We place unearned revenue in the debit for 100. What is 100? 100 is the amount that belongs to 2019, because those service revenues related to December, January 2020, February 2023 month is here. So for 2019 only 1 month is related to 2019. So 1,200 divided by 3 equals 100. This is the share of 2019 in these revenues. And we place service revenue in the credit because it's a revenue. This will be placed in the income statement, and the difference between unearned revenues in the debit and the previously placed unearned revenue in the credit, the difference between these two will be placed in the balance sheet as a liability. One last case is the case of accrued expenses. What are accrued expenses? Accrued expenses are expenses that incurred but not yet paid, or expenses that occurred prior to paying it in cash. For example, on December 31, 2019, the company didn't pay December salaries. So the year ended and we still didn't pay 5,000 salaries. These are accrued expenses, which is a liability on the company that should be paid later on. The adjusting entry for accrued salaries will be as follows. Salaries expenses will be placed in the debit because expenses incurred for 5,000 and we didn't pay it yet, so it is called salaries payable. Payable means it's a liability that will be paid later on. And we place salaries expenses in the income statement as an expense. Salaries payable will be placed in the liability within the balance sheet.